Hey everyone, today we're exploring something really important to understand, moving averages. Trust me on this one, grasping this concept can really give you an edge in the market. Seriously, doesn't matter if you're into forex, crypto, stocks, whatever. Understanding this is seriously valuable. You're a scalper trying to grab those quick little profits. This helps you see the short-term trends. You're more a day trader looking at those bigger market swings. This gives you a context for the overall direction. It really applies to pretty much any trading style you can think of. Some traders even call it the father of the indicators. And honestly, when you start to understand it, it's easy to see why. It's like a foundation for so many other trading techniques and strategies. There are 4 key things you really need to understand. These aren't just some little tricks or anything. They're the essential pieces that makes a moving average strategy work. The first thing, and this is super important, is finding markets that are actually trending. This is where everything starts, really. You need to know which markets are moving with some real direction. Because let's be honest, trying to use a moving average when the market is just going sideways, chopping around, it's like trying to drive a boat in a parking lot. It just doesn't work. The next thing we need is entries. When do you actually jump into a trade and at what price? That's based on, we're going to break down exactly how to find those sweet spots, those perfect entry points. Then we've got the stop losses. This is all about protecting your money. Where do you put the safety net? That point where you say, okay, if the trade goes against me this much, I'm out. And finally, this is the part everyone's really interested in. When do you take your profits? When do you exit the trade and lock in those gains? This is just as important as knowing when to enter. You don't want to get greedy and then watch your profits disappear, right? So let's talk about finding those trending markets. This is absolutely key. No matter what kind of trading you're doing, at their core, all traders are really just following trends. It's about figuring out where the market's headed and riding the wave. So your main goal is to find markets with clear, strong, and consistent trends. That way, when you jump in, you're maximizing your potential profits while keeping your risk in check. One of the best ways to spot those strong trends is by looking at how the moving averages slope. If the moving average is pointing sharply upwards, that tells us we're in a strong uptrend. And if it's just a gentle slope, the uptrend is weaker. The same goes for downtrends, just other way around. A steep downtrend slope, a strong downtrend. A gentle downtrend slope, weaker downtrend. And here's another thing to look for. In an uptrend, you'll typically see the price making what we call higher highs and higher lows. Basically, each peak of each valley is higher than the last. On the flip side, in a downtrend, you'll see lower lows and lower highs. Each peak and valley is lower than the previous one. This is a classic sign of a trend in action. Now in this strategy, we use a combination of different moving average settings. You can see them here on the chart. This helps us get an even clearer picture of potential trends. So the big question is, when these moving average combinations really light up and show us the best opportunity? Check this out. If we take away the price chart for a second, just look at the moving average lines. See how they interact. If the yellow line is below the white line, that's a sign of a strong downtrend, what we call a bear market. And the further apart those lines are, the stronger that downtrend is. On the other hand, when the yellow line is above the white line, that means a strong uptrend or a bull market. Again, the wider the gap, the stronger the trend. Alright, so now we're talking about those perfect entry points. These are the moments right after the price pullback a bit during a strong uptrend or downtrend. So the big question is, what makes a pullback a good pullback? One that's likely to mean the trend is going to continue. Let's look at this example. See how the moving average lines are sloping upwards? That tells us we're in an uptrend. Now we wait for the second thing, a high probability pullback. This is when the price dips back down towards those yellow and blue lines before it starts heading back up. Once we see that pullback, we can find the recent swing high, what we call a higher high in an uptrend. This is a crucial level, so we draw a horizontal line there. Now we need to be patient and wait for the price to close a candle above the higher high line. If that happens, it's a strong buy signal. Prime time to enter a buy position. You feel pretty confident about it. Now, what about selling? Well, it's basically the same idea. Just flip. Let's say we're in a strong downtrend. Let's see the moving averages are sloping downwards and the price moving away from the yellow or blue line. Then we wait for a pullback towards those yellow and blue lines. We find the recent swing low, what we call it a lower low in a downtrend, and draw a horizontal line there. Then wait for a candle to close below the lower low line. If that happens, that's a strong sell signal and a good time to enter a sell position. So it's the same principle, just working in the opposite direction. Okay, so now we're getting into a stop loss placement, which is super important for protecting your money. With this strategy, there are two main places you can put your stop loss, and where you choose really changes how much risk you're taking and how much you could potentially gain. The first option is placing your stop loss around the recent swing in the market. This means you're looking for the most recent swing high if you're in a short position, and placing your stop loss just above it for a short position, or low if you're in a long position, and placing your stop loss just below it for a long position. This approach is more aggressive because your stop loss is closer to your entry price, but it can also lead to higher potential profits if the trade goes in your favor. The other stop loss option are around the blue, yellow, or white moving average lines. You can choose the line that is closest to your entry price. This approach is more conservative because your stop loss is further away from your entry point, but it also means you're less likely to be stopped out by normal market fluctuations. Here's a quick comparison of the two approaches. Aggressive stop loss, closer to your entry price, higher potential profit, higher risk of being stopped out. Conservative stop loss, further from your entry price, lower potential profit, lower risk of being stopped out. Ultimately, the best approach for you will depend on your risk tolerance and your trading style. Alright, let's talk about taking profits, the fun part. This is where we lock in those gains and make all our hard work pay off. The question is, how do we set realistic targets and know exactly when to exit a trade to really maximize our profits? With this strategy, we have two different ways to exit, giving us some flexibility depending on the market conditions. First, we have the simplest and often most reliable method, using a fixed risk to reward ratio. Especially, we're aiming for 1 to 2 risk to reward ratio. What does that mean? It means we want our profit target to be double the amount we're risking on the trade with our stop loss. Why is 1 to 2 risk to reward ratio so effective? Well, it's a balanced approach. It's achievable, meaning you're not setting unrealistically high targets and it really adds on in the long run. Even if you don't win every single trade, as long as your win rate is above 50%, this ratio means you're profitable overall. For example, if you win 5 out of 10 trades, you've made $100 profits and lost $50, resulting in a net profit of $50. The second way to exit a trade is by watching for the price to cross back over the blue moving average line. This method is more dynamic and allows you to potentially capture longer profits if the trend continues strongly. The idea here is that as long as the price stays on one side of the blue moving average, the trend is likely still intact. But once the price crosses back over the line, it can signal a potential trend reversal or at least a significant pullback. Using the blue moving average as the exit signal can sometimes lead to even bigger profits than the fixed 1 to 2 risk to reward ratio. If the trend is really strong, the price might continue to move in your favor for a long time before crossing back over the blue line. This allows you to ride the trend for longer and maximize your gains. However, there's also a trade-off. There are times when the price might only briefly cross back over the blue line before resuming its original trend. In this case, you might end up exiting the trade with a smaller profit than you could have achieved with 1 to 2 risk to reward ratio, or even a small loss if the price reverses quickly. So while the method offers the potential for longer gains, it also introduces a bit more variability in your results. So the really cool thing about this strategy is how simple it is to set up. It uses just 3 moving averages, the 200 period EMA, the 90 period EMA, and the 45 period EMA. That's it. It's really straightforward.